In the intricate dance of modern economics, a single institution often takes center stage, its every move scrutinized, its decisions echoing through the financial lives of millions. This is the story of the Federal Reserve and its powerful tools for controlling the nation's money supply. But how does this financial behemoth actually steer the world's largest economy? It all begins with a deceptively simple goal: to manage the amount of money circulating within the system. Behind the imposing facade of the Federal Reserve, officials gather to make decisions that will ripple outwards, influencing everything from the cost of a car loan to the health of the entire job market. Their mandate is complex, but their methods, while powerful, can be understood by breaking them down into 4 key mechanisms. The most frequently used tool is open market operations. Imagine the Fed as a major player in the financial markets, stepping in to either buy or sell government securities, like bonds, from commercial banks. When the Fed purchases these securities, it's essentially injecting new money directly into the banking system. This infusion of cash increases the bank's reserves, empowering them to lend more freely to businesses and individuals, stimulating economic activity. Conversely, when the Fed sells securities, it pulls money out, tightening the financial reins. Next is the discount rate, which acts as a foundational interest rate for the entire banking system. This is the specific interest rate at which commercial banks can borrow money directly from the Federal Reserve itself through what's known as the discount window. Think of it as a financial backstop for banks. By lowering this rate, the Fed encourages banks to borrow more, increasing their lending capacity. A higher discount rate makes borrowing more expensive, which can help cool down an overheating economy by discouraging lending. Then we have reserve requirements, a rule that dictates the minimum fraction of customer deposits that banks must hold in reserve rather than lend out. This money is essentially locked away, ensuring the bank has enough cash on hand to meet unexpected withdrawals. By adjusting this requirement, the Fed can directly influence the amount of money available for lending. If the requirement is lowered, banks can lend out a larger portion of their deposits, expanding the money supply. If it's raised, the opposite occurs. A more modern tool is interest on reserve balances. The Fed pays interest to banks on the reserves they hold, both required and excess. By adjusting this interest rate, the Fed can influence a bank's decision-making process. If the rate paid on reserves is high, banks might prefer to simply park their excess cash safely at the Fed to earn that risk-free interest. If the rate is low, they are more incentivized to lend that money out to the public in search of higher returns, thereby increasing the money supply. Through the intricate interplay of these 4 tools, the Federal Reserve strives to achieve its dual mandate, fostering maximum employment while maintaining stable prices. It is a delicate balancing act, a constant effort to fine-tune the economic engine, ensuring it runs neither too hot nor too cold. The goal is a steady, prosperous economy where jobs are plentiful and the value of a dollar remains reliable. As the sun sets on its marble columns, the Federal Reserve stands as a silent guardian of the economy. Its work is a continuous, complex, and often unseen process, yet its influence is a fundamental force shaping the financial currents that flow through the heart of the nation.